Hey, happy hump day to all of our options traders out there. Yes, it's Wednesday. We're over the halfway mark, and I have another video for everybody. This is a little bit of a carryover from the last video where we asked the question, can an at-the-money option ever beat an in-the-money option in terms of price? And so we found out in that video that the answer was no, but what about with volatility? See, an at the money option has sensitivity to volatility, or at least a greater sensitivity to volatility, what we call vega. So, is it possible that we keep the stock price the same and just start increasing the volatility? It seems like maybe there, because the stock price isn't changing, that maybe the at the money could actually outperform the in the money again in terms of total dollars. Well, is that true? It's important to understand your strategies and how they're going to behave over time. So let's go find out more. As always, please be sure to click like and subscribe. It's greatly appreciated and helps so much to promote the channel. So let's back up to a pricing principle. This is really from the last video, and we've talked about this before, where lower strike calls and higher strike puts must be more valuable. That's assuming that obviously we're talking about the same underlying stock, but that they have the same expiration. However, at the money strikes are more sensitive to volatility. So again, the question that we're trying to answer here, can increasing volatility raise an at the money options price above the in the money options price? And it seems like it should. If we're keeping the stock price the same and we keep raising the volatility, it seems like the at the money options price is going to increase while the in the monies is just going to sit there. Well, let's see exactly what's going to happen. The stock is trading for 100, and we're going to compare the $95 call to the $100 call. Now, it doesn't really matter which expiration we use, but as long as you're comparing the same expiration, you're going to find that this is always going to be true. So yes, both options are sensitive to volatility. So that means that the $95 call price rises and the $100 call price rises. However, and this is important, the $95 call, being a lower strike, has a $5 head start. So changing volatility only changes the absolute values, but the relative values stay the same. So for example, here is a chart showing the price of a $95 call, again for some expiration, and we're going to subtract off the price of the $100 call. So lower strike calls have to be worth more money. So maybe we have 7 minus 5 is a positive 2. That's what we're plotting here as the stock price rises. So notice that if the stock price is really low, let's say down to 0, then both of these options are worthless, and the difference between them is 0. As that stock price starts moving, now we're getting up towards these strikes of 95 and 100, we can see that this difference starts growing. However, once we get deep in the money, let's say roughly maybe a stock price of 130 or so, we start getting really close to a $5 difference. And notice that that is the difference in strikes. So that's going to be the case that whenever that stock price goes up, no matter how high, the prices with these two options are going to converge to a $5 difference. So again, this is a little bit of a review from the last video, and it just shows that the at the money option will never outperform the in the money option. Now in that video, we showed kind of a strange case where that could happen, where if the difference in the prices was greater than the difference in strikes. And of course, we showed that that would be an arbitrage, so you really shouldn't ever expect it to happen in the real world. So this graph is more what you're going to see in the real world, that the in the money option always beats the at the money option in terms of the total price. Now, what about for volatility? Well, we're going to do the same thing. We're going to take the $95 call and subtract off the price of the $100 call. But now instead of a stock price, these are volatilities. So watch what happens if we have very low volatility. Both options are worthless. There's no difference in their prices. But as we start increasing volatility, we see that we get a difference in their prices. Remember, that's what this number is. It's the difference. So now we have a dollar difference, a $1.20 difference. Looks like maybe a $1.50 difference at the peak. And then as we continue to increase volatility, the total option prices are increasing, but the difference is starting to fall. We can see we're kind of going off a cliff here. And then if we push these volatilities super, super high, we eventually go to where there's no difference. They will collapse on the same price. So what is that price? Well, it turns out that it depends on whether we're talking about calls or puts. So let's go see these in action with a pricing model. So now we're into an Excel spreadsheet. This is the Option Strategy Simulator from Macro Option. That's the website. And I've shown these before. It's a great tool. They have several different pricing models and tools. They're one-time fees, pretty nominal fee, but they're really, really cool spreadsheets. So what we're going to do here, let's change these to 30 days as well. And we're going to look at the $95 call and the 100 call. Notice these are both calls. And we're going to look at the 95 put and the 100 put. So over here is the price according to the pricing model. We have the stock at 100, 30% volatility, no interest rates. So let's just focus on the calls for right now, these top two prices. We're going to push that stock price higher and higher, start pushing these options in the money. So again, this is a review from the last video. So let's come up here and go to 110, and now we get $15.16 and 1061. See, they both went up, but we're starting to converge on the same difference. That's what that previous graph was showing. Let's go up to 120 for a stock price. Now we have 2501 and 2006, starting to get even closer together. Let's go up to 130. Now we see the 95 calls price at 35 and the 100 calls price at 30. They are exactly $5 apart. And once we hit this, we're never going to break that. We can certainly increase the intrinsic value, but they will always remain $5 apart. So even if we make this 200, now we have 105 and 100. Again, just separated by $5. Now, notice that the put options down here, the bottom two, went to zero. And that's because they're just super far out of the money. So let's go the other direction. We started at 100. Let's go to maybe 90. Now we're going to get the opposite effects. You're going to see the call option starting to move towards zero. And these should start moving towards a $5 difference. Let's drop it some more. Let's go to 80. See, the calls are going to zero. Now we have 1506 and 2001. Let's go to 70. And there we go. Now we see that the higher strike put, that's the one that's more valuable, trading for 30, and the 95 is 25. There's a $5 difference in these options, and that's because there's a $5 difference in their strikes. So no matter how low that stock price goes, you're going to see that all you're going to do is dump in more intrinsic value, but that $5 difference is going to remain. All right, so again, that's a little bit of a recap from the first video. We're showing that if you move the stock's price, that the at the money cannot beat the in the money, at least in terms of dollars. Certainly in percentage terms, the at the monies could outperform. But now let's turn our attention to volatility. Let's keep the stock price the same at 100, keep the time the same. We've got the same strikes. Now let's increase the volatility to, let's say, 50%. What happens now? The call, 95 call goes to 842, the 100 at 571, and we see 342 and 571. But we can see that the call prices are starting to get closer together. But will they ever match, or will the at the monies ever beat it? So let's go up to 100% vol. Now we see the 95 call is 1379, the 100 is 1140. Looks like they're getting a little closer together. Let's go to 200 vol, 2459 and 2257. Let's jack it up to 500 vol. Now, of course, that's highly unrealistic, or at least we hope that it is. But look at the prices, starting to get closer together. Let's go up to 1,000 vol. Again, getting closer. Let's go to 2,000 vol. Getting closer. Let's crank it up to 3,000. What happens now? Well, now we see that both options have the same price. So in terms of volatility, the at the money could tie it. But notice that they're moving towards 100, which is the stock's price. And that's another pricing principle. As that volatility starts to increase, all call options will start moving towards that stock price and then never budge. What the pricing model is saying is that if the volatility is that out of control, you're essentially just trading the stock. So watch these two prices right here, 100 and 100. If we make this 5,000, not going to change. That's a limit right there. It's going to be equal to the stock price. But now take a look at the puts. The 95 put moved to a price of 95, while the 100 put moved to a price of 100. What's going on here? Well, the put options start moving towards their strikes. So as the volatility starts increasing, you can see that this 95 put was moving towards a price of 95, which is essentially saying that the options bottomed out. Stock could just as easily be trading for 0, so it's worth the strike. But the 100 put, being $5 higher, is going to be priced $5 higher at 100. So again, they're just moving towards their strikes. So we're finding out that the answer here, as we found out in the presentation, is that the at-the-money option cannot beat the in-the-money option, whether you crank up the stock's price or whether you crank up volatility, or even if we went through both and actually increased the stock price and the volatility. Let's make this 200. And now we can see that, again, the call options are just moving towards the stock price, but the put options stay moving towards their strikes. So once again, those are just some really important pricing relationships that are important to understand for things like spreads, calendar spreads, butterfly spreads, all kinds. But if you understand these relationships, it will help you to make better sense of how to construct your strategies and what to expect as the stock price or volatility change. And when you make better decisions, you're going to have better outcomes. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.